All right, stocks on a little pre-election, pre-Fed QE2 rally. Let's bring in our expert insight for the close. John Brady is Senior Vice President at MF Global. He trades fixed income futures and options. He joins us from the Chicago Mercantile Exchange. And with us here in New York is Art Hogan. He is Chief Market Analyst at Jefferies Company. He serves on the NASDAQ Board of Governors. And, you know, guys, before we get to it, there's a lot to talk about. Obviously, the elections, QE2, even Friday's jobs numbers. But I want to focus in on the markets here. Art, up 1% today. We had a fantastic October. Before that, we had an incredible September. What's going on with this rally? Why? Is it all due to QE2?
No, it's about a third QE2. Think about the fact that we spent the better part of the summer worrying about a double-dip recession. So we sold off in June, July, and August. We got that back. So we had to get back 8% before we went up 12% in September and another 3% in October. So half of the gains are just crawling back from the fact that we didn't go to a double dip. Put those concerns behind us. Now we're trying to price in QE2. We don't know how big that gets. We'll find out tomorrow. We don't know what the election results mean. Is it more pro-business? Is going to be a more business-friendly environment? And I think the third thing, which is, you know, I think not getting enough notice is, you know what? Multiples look attractive here. We're trading at 12 times 2011 earnings. So, you know, if you have three choices and you can buy stocks, bonds, or commodities right now, I think stocks are probably the most attractively valued asset.
Art, what I find mind-boggling is the idea that we need QE2 is not necessarily a good sign of the health of kind of our financial system or our economy at that point. When do investors realize that the Fed pumping in more money is not necessarily a good thing?
Yeah, that's a great point.
It means we need help.
Yeah, you don't want to have that massive shock and awe QE2 announcement. You want to have something very gradual, very open-ended, and something that can stop at any point in time. If the Fed looks at the economic conditions and says, you know what, we don't need to do more than 125 or 150 billion, we are going to stop here.
Are investors going to be comfortable with that, you think?
I think they are. I think not at first. I think the first knee-jerk reaction is, okay, let's sell stocks. It's bad news. The dollar's going to firm up and commodities sell up.
Right.
The overall impression will be, oh, wait a minute, things are getting better. The Fed doesn't have to be as aggressive.
John, what are you guys thinking there on the floor out there in Chicago? You guys ready for more QE2 here?
We are, Carol, whether we want it or not, we're certainly going to get it. I would take issue with Mr. Hogan. I do think that perhaps if the economic data were to turn around suddenly in such a way where the Fed would then start to perhaps put QE2 to the sidelines and not fulfill, let's say, their $500 billion obligation, I think it would probably lend itself to a burst of volatility in asset markets. I think Fed officials want to be very, very careful not to do that. I do likewise would suggest that I would think the 7 to 10-year sector in yield terms would probably rise, which would probably put a little bit of a harmful effect on the housing market and home prices. So I think at the very least they will probably do $500 billion worth. But I think Mr. Hogan's right. I think they'll leave it very open-ended. They become politically very, very sensitive. And at the same time, they're fighting these multi-year deflationary headwinds that they certainly don't want to claim victory too early.
John, you're right. But I think that if you look at this, and I think the overarching point is here, you know, are the economic conditions at a point right now where we need that $500 billion, or are things getting gradually better? Are we looking at GDP growth rates in 2011 that on their own without stimulus would actually grow to 2.5%, 3.5%? And is that enough? Is the Fed overreaching here? Is it going to be hard for them to pull back all the stimulus they're putting into the system when eventually they have to? My fear is perhaps that they go too far and then they have to pull back too quickly and the dollar, you know, does a rip to the upside. Commodities get shattered, at least in the near term, and stocks follow suit.
John, you got any reaction to that? Yeah, go ahead.
Art, you know, my fear is on the other side of the table. I fear that this economic recovery is still going to run at stall speed. I think job growth is going to continue to be anemic. We have a fear at MF Global specifically as it relates to the continuing decline in average year-over-year hourly earnings, the lack of income growth. And we do understand and agree that the Fed is certainly trying to support asset prices, both in equities and in the housing market. But at some point, the marginal benefit of doing that from QE1 to QE2, possibly to QE3, will become less and less. And so that's a little bit of a fear for us, or at least a near-term risk that I think the Fed's going to address through their statement tomorrow.
All right, I got to throw this out to you because I think you said 12 times 2011 earnings, right? You were saying the market's cheap. Lincoln Ellis is often a guest on with Matt and me. He said that means 2011 numbers are way too high. Do you think the estimates that are out there are still way too high?
You know, it's funny. We've been saying the numbers are too high for the last 2 years. We've had 3 terrific quarters of earnings in a row, and guidance has gone up. And for the last 5 quarters, it's been very difficult to get any guidance coming out of this recession.
Yeah.
Numbers came up with this. People are guiding higher. corporate America is lean. They've figured out a way to make money in a slow growth economy. They're going to continue to do that. And I think that, the fear that, oh, wait a minute, those numbers are too high, so the multiple is really something higher than that. I would take the argument the other way. If you actually took the S&P 500 and backed out the sort of low tier, dropped out the low-hanging fruit that shouldn't be in there anyway,
right,
and at some point in time gets cycled out, the multiple is probably closer to 10. So I think in terms of an argument, I think the best argument to make is, where do you want to be next year? What's going to be the best sector to be in? Is this commodity play going to play out? Is it overcrowded? Is the bond market in a bubble right now? Is that trade getting tired? Or do equities look like the best trade here? And I think in 11 it's going to be. I think that's going to be the headline news.
Hey, John, as a fixed income trader, let me get your take on that. I mean, is the bond market in the bubble? Do you think the commodity markets are overcrowded? Is the Fed's action going to add even more fuel to this fire?
Brian, I want to take it a little bit of a step to the right, if you don't mind, and throw something out there. As a bond trader, we're very concerned about Fed policy, monetary policy, the slope of the yield curve. And as we head into QE2 tomorrow, fear for bond traders, and I'd love to hear what Mr. Hogan has to say, fears for bond traders is that the Fed will now be competing with banks, large commercial banks and financials here, in buying Treasury securities in the 7 to 10-year sector and maybe further out. And as you know, that holds negative ramifications for banks who are relying more than ever on net interest margin and net interest income from the income they derive from their Treasury holdings. They're holding those Treasuries, as you know, to perhaps rescue their balance sheets from the credit crisis and the mortgage pain that they're currently incorporating. We think stocks can go higher next year. We worry about the financials. I was wondering if Mr. Hogan would have any comments specifically as it relates to QE2, the Fed, and net interest margin for banks.
I think that's a great point. I think one of the things, so John, and I take the other side of this argument, just stated simply like this. There's $1 trillion in excess cash reserves sitting in money center banks. Obviously, there was a reason for that. We got to a point in time in the financial crisis where that needed to be injected. That's sitting there. I think the real issue is not is there enough cash and is the Fed putting too much into the work? Is the conduit working? Is that money actually getting from those banks out into the hands of the people that need it to create jobs, the small and medium businessmen? So I certainly understand your concerns here, but I think that what needs to be fixed is the conduit of lending, whether it's the demand for loans or the willingness to lend. Something needs to break that logjam because there's cash out there. It's just not being put to work, and the velocity of money needs to pick up before we can get any sort of sustainable recovery next year.
Hey, listen.
Right. No, I think that's a valid argument.
All right. And I want to throw one other argument into this, or one other issue that we've been looking at here, and that is the VIX. We've seen quite a move up. It's been up about 16% over the past 6
Even as the market
straight
rallies,
days.
right?
Even as the market rallies. A little bit of a pullback today. Matt Shapiro, I know you're going to jump into this. He's president of MWS Capital. I mean, Matt, what do you make of the move that we've seen in the VIX as of late?
Well, there's lots of underlying tension with all these news events that are going to hit. Now, obviously, as you pointed out, the VIX has risen from a low of about 19. It's creeped up, risen steadily every day to 22. But today, we finally had a big move in the volatility in the VIX options. Think of the volatility of these options traded on the VIX as credit default swaps on the market, and they rose rapidly in the last hour. There's been heavy trading in the pit. Shows there's a lot of nervousness before this election tonight.
But not surprising, Mark, to see that trade before elections, not to mention a ton of news this week.
Absolutely. You've got Fed, elections, and an unemployment report, and volatility was relatively low in these options. So think of the VIX as having a range of between 19 and 25 over the next week.
Do you care about the VIX?
Yeah, we do care about the VIX. It should be telling us that something's going to happen soon. It should be a barometer. It worked a lot better when markets were a lot more volatile. Remember, we went through a period of time in 2008, 2009 where we couldn't go 3 days without having a 300-point swing in the Dow.
Right.
We've settled down from that point in time, and so has the VIX. The VIX is coming significantly. But it should be predicting that this is a catalyst-filled week. It was probably one of the most news-heavy weeks and one of the most anticipated. I find it hard to believe that at least one or maybe all of the events that happened this week aren't something that will be selling the news. The Fed is going to be in a hard place to do something that isn't in line with expectations. They're not going to exceed expectations, so there's a sell in the news phenomenon there. You've got the elections. We know the House is flipping. The Senate's going to be too close to call for a while.
And then there's the jobs report.
And the jobs report, that could be the only upside surprise we get this week.
All right, we got to run. Hey, guys, thank you so much. Art Hogan right here in studio, Matt Shapiro out there at MWS Capital, and also John Brady over at MF Global. Guys, thanks so much.
And Lincoln Ellis coming to us virtually.
He will be
here in person, by the way, on Friday. I don't know if you knew that.
I do know now.